what I've observed with the best traders I've worked with, and that I've observed and had the opportunity to get coaching from, et cetera, is that they're very humble to the market. They're very curious. They have this sense of curiosity of, I don't know what's going to happen next, but I'm very curious to see what's going to happen next.
So welcome to Community with Around with Pat Bailouni. Looking forward to talk about psychology of trading and how we can actually perform better in trading. So Pat, welcome back on the podcast. Good to have you here again, of course. It's been a while. So I want to kind of catch up and tell me kind of what's been going on since we last spoke, I think a year ago or so.
Yeah, so I've been quite busy. I've been working with a lot of traders, trying to really understand what's going on in their heads, their behavior, their psychology. I did some travels for the last 8 months, meeting with clients and meeting with students, just to have more face-to-face interaction as well, to help them understand what's going on in their heads. I've developed some new trading psychology principles and some new ideas, which I'm really, really excited to share today. So,
when it comes to psychology, people are trying sometimes I feel they're trying to force it too much. Like they have a discipline issue, then they try to force discipline, or they cannot hold their trades, so they try to force themselves to hold their trades. And it doesn't really work too well in that case. So how can you actually kind of fix your psychology in trading?
Yeah, it's an interesting question. We can talk about that for a couple of hours, I think. But I think one thing that traders tend to overlook, or they misunderstand, is that you need to have a good strategy, a good trading strategy, and a very clear mechanical trading plan if you want to expect your mindset to be on point. A lot of traders, they're trading a strategy that isn't necessarily profitable. They haven't put that strategy into a mechanical trading plan, and then they come to the market and they're overwhelmed by the market. They're overwhelmed by decisions. And what tends to happen in the psychology when you're overwhelmed is your brain goes into more of a survival state. Your amygdala gets heightened, and you become more reactive in the markets. And you put your psychology in a very vulnerable situation if you don't have a clear set of rules, a checklist, a trading plan to guide you. I sometimes use the analogy that the market's like a jungle. You can't expect yourself to navigate the jungle if you don't have a clear map, if you don't have a clear objective. So one of the easiest things traders can do, obviously I talk only exclusively about trading psychology, but what you should be doing before you focus on your trading psychology is make sure you have a profitable strategy, and then putting that profitable strategy into a clear mechanical trading plan. And then the game becomes about managing your psychology so you can actually stick to that trading plan. Talk about managing fear and greed, managing expectations, taking care of the other components of your life so that you're not disempowered in any of the areas. There's a lot of different components that we can talk about, but step number 1 is having a profitable edge. Step number 2 is putting that profitable edge into a mechanical trading plan. Step number 3 is then managing fear and greed so that you stick to that trading plan. That's sort of like how I would ease a trader into trading psychology.
All right, makes a lot of sense. So let's kind of focus on expectations first, because I think that's the thing for beginning traders, like having the right expectations for trading, trying to not aim for getting rich in a week or something. How do you sort of balance out goal setting? Like you want to be able to achieve goals and reach a good level in trading, but also not try to overly achieve or overly set big goals that you cannot achieve.
I like to break it down into 2 different schools of thought. You've got outcome-based thinking, or an outcome-based mindset, and a process-based mindset or process-based thinking. I think every trader, they come into the markets because they have these ideas of the lifestyle and the money they want to make and the freedom they want to have, and that they don't like their job, they want to get away from their job, etc., etc. So those are all outcome-based goals, outcome-based expectations, or outcome-based ideas. The truth is, fixating on the outcome-based goal or idea or expectation isn't the thing that's going to actually get you there in the first place. What you need to do is you need to have proven processes that you consistently execute on, that are proven and are shown to be true, that you can execute on, that will ultimately get you that outcome. So what I encourage traders to do, and this is really what I share with a lot of my students, is that you have the outcome in your mind, you know where you want to get to, you have the expectation of what you want from trading, and then you want to strategize. Where am I currently? And then where is that goal? And then what's the difference? What's the strategy that's going to get me from where I am to where I would love to get to? And then really what you're focused on day to day is the process. You can almost forget about the outcome, and you can write that down in a Notion document in your goals, you can put it away, and then every day you wake up and you focus on executing on the process, which is the high priority actions that will get you to that outcome. And then in 3 or 6 months time, you'll look back and you'll be like, oh my God, I accomplished the outcome that I set because you worked backwards. You knew what the outcome was. You knew where you were. You planned the process, the strategy to get there, and you just focused day to day on executing on that process, executing on that strategy. So have a goal, but don't fixate on the goal. Use that goal as a way to strategize the process and the high priority actions, and then focus, put your energy and attention on executing on the high priority actions every day. That's what will ultimately get you there in the first place.
I love that focus on the process. The thing is, like, there's people on YouTube telling you can do like 2,000% a year, and they will show you like how you can flip your account so quickly. I think a lot of beginner traders are like stuck in that mindset too of like trying to flip things quickly because they see it on YouTube or because like some guys told them about it, and then they kind of try to risk too much, and they have the psychology issues coming up, and then that's kind of why it's hard to maintain discipline if you kind of try to gamble your way in trading.
Yeah, you question in the first place, is that even trading? And at the end of the day, it's not. It's gambling. So you have to be aware of the hype, the marketing. You have to be aware of the agenda behind some of these videos and what's being promoted. And you have to understand that a lot of it's just hype and marketing, and it's simply not true. And I think traders have to go through. This is why the journey is so important. This is why no trader necessarily makes it overnight. It's because you have to fall into those traps. So you have to go through those experiences to almost, it's like when you touch a hot stove, you get burnt the first time, you never touch a hot stove again, or a hot whatever, on the stove. You train your psychology to realize that, the journey of being a successful trader, it's very boring. You shouldn't be shooting for these large returns. It's about sticking to the process and consistently executing on the process. And I try and tell traders that sometimes, but sometimes it's wise just to leave them, let them learn their own lessons, and then they typically come back when they're a little bit more grounded and ready to learn the principles that will actually help them become a successful trader.
In trading, depending on how you do it, there's like pressures. Like if you, let's say, want to go and trade for a prop firm, it's like pressure that you have to perform for that prop firm. If you trade on your own full time, it's like pressure that you have to make your own kind of salary over time. How do you handle these pressures that come with trading?
Yeah, there's a lot of them, right? It's like being a full-time trader is a very, very good example. There's a lot of traders who have this idea of, I want to become a full-time trader. And the idea in their mind is only the positive side of it. They have this fantasy or this idea of what full-time trading will look like. And in their mind, it looks like, all right, I'm going to come to the market, I'm going to make money very easily. It's going to have all this freedom throughout the day. I'm not going to have any issues. I do what I want to do. I go to the beach, etc., etc. And the reality is far from that. The reality of being a full-time trader or being a funded trader is that you're going to have advantage. Yes, you're going to have more freedom. You're going to make more money, but there's also going to be greater stresses, and there's going to be greater responsibilities and accountabilities that come with that as well. So you got the drawbacks there as well. So it's important to recognize first and foremost that the goal that you're shooting for, whether it's a full-time trader or a funded trader, has two sides to it. It's going to have advantage, but it's also going to have disadvantage. And there's actually a process that you can go through of writing down all the drawbacks, all the risks, all the things that could go wrong if you're a full-time trader or a funded trader. So you're aware of those in advance, and you can be aware of both sides of the goal, and then you plan and prepare for everything that could go wrong. So for example, one of the biggest challenges being a full-time trader is that you don't have a reliable source of income through employment, for example. You're not going to get a paycheck every couple of weeks or every month. And that's a true risk or a true drawback where you may not get paid for the month. So if you're aware of that in advance, you can then ask yourself, all right, what am I going to do to plan and prepare? And if I don't get a paycheck, how can I lower the probability of not getting a paycheck? And how can I lower the impact if I don't get a paycheck? And you can have cash savings there. You can be prepared for those vulnerabilities or for those risks. My point here is that traders are sometimes pursuing fantasies. They're pursuing these one-sided, fantasies that aren't even real. In reality, it's not even true. So you want to, in advance, be aware of what could go wrong and plan for what could go wrong, and you're automatically going to be more and more grounded. But I also encourage traders not to jump to becoming a full-time trader, because the reality of it's very different to what's marketed. And again, it's sometimes the lesson you have to go through to learn, the experience you have to go through to learn the lesson. But I encourage traders not to. I encourage traders to work a full-time or a part-time job if they can. Use that as a source of income to build up cash savings. Have 6 to 12 to 18 months of cash savings before you even think about going full-time. and then recognize that you can trade full time. You can also work a part-time job, so you have that source of income as well. You can dedicate your time to additional businesses that generate income, whatever it may be. But always have that healthy skepticism of being a prop firm trader or a full-time trader, because we're inundated by positive marketing, and that's just one side of the story. You have to be aware of the other side as well. I mean, we can talk about prop firms as well. We had some of the recent challenges with some prop firms, and that's just the reality of the situation. You have to be aware that there's no such thing as a free lunch. There's no such thing as free money. There are going to be drawbacks to prop firms. There are going to be vulnerabilities, and there are going to be things that happen. You have to be aware of these things. You have to plan and prepare for them. I had many clients who messaged me after, I don't know if we can use with the recent prop firm that went under.
Yeah, feel free to go ahead. Yeah.
And they lost max allocation. So I empathize with them. I recognize that that's challenging for a lot of people, but the best traders out there were diversified. They knew that these things could go wrong, issues could happen, so they were planned and prepared for those things in advance. So don't be vulnerable to the marketing. Be healthily skeptical, if that's even a word, and plan contingencies for everything that could go wrong. And you're going to put yourself in a much better position as a trader, rather than pursuing fantasies and thinking that there's this all positive thing out there, which is just not true. It's not the reality.
Yeah, I think it's a really good lesson in diversification, diversifying your, first of all, what you trade, diversifying your incomes. You have multiple ways to make money, and diversifying the prop firms, where you get your capital from. It's definitely important.
100%. I completely agree. And I may even mentioned it on our first interview, because I spoke about this a lot on my previous interviews, because what I noticed is that the language people using around prop firm is that, it's free money, it's easy money. There's no such thing as a free lunch, and it just takes some time until you see the other side. So I think what's happened with this recent situation has been a big eye-opener to everybody in the industry, that there are drawbacks to prop firms. That doesn't mean prop firms are bad. They're still a great tool to utilize, but you have to recognize they're going to have two sides to them. You have to be aware of both sides.
There are people in trading who, not maybe the majority, but some people see everything as a scam. They see the broker as a scam. They see the prop firm as a scam. They see this is a scam, that's a scam, this journal platform is a scam too. How do you make your way to trading when you see things as scams everywhere?
Just like any industry, there are scams in any industry, right? I think it's important to do research, important to have a look at what's regulated, what's not, and all that type of stuff. I mean, with brokers, you want to stick to the more secure, bigger brokers. Typically, they're better options. I think it comes back to what we're talking about, Etienne, with diversification. Recognize that it's important to stay diversified. If you have a lot of capital, divvy up your capital, put it into multiple different brokers. Utilize the leverage so you can keep your majority of your capital in safer interest-bearing accounts. And be smart. I'm starting to promote this healthy skepticism. When I speak a lot with traders, I'm trying to promote, just be a little bit skeptical and recognize that, just to counterbalance the positive marketing out there, just be a little bit skeptical, question things, and recognize that there are drawbacks to these things. You want to be aware of them. You want to be prepared for them. That exercise I mentioned before is very, very important. If all you're seeing is the benefits of a broker, all you're seeing is the benefits of an educator, if all you're seeing is the benefits of a goal, you're not prepared for the reality of that. And if you're excited over a goal, it means that you haven't seen the other side of it, and you're unprepared for the reality of the goal. So by asking yourself, what are the drawbacks? What are the risks? What are the disservices? What could go wrong in this situation? And sort of balancing yourself out a little bit so you're aware of the other side of it, you put yourself in a much more stable and balanced perspective to actually go off and accomplish the reality of that goal.
You talk about these keys of good trading psychology. Do you want to kind of maybe introduce us to what are some of these keys, or these key pillars, these key lessons for good trading mindset and trading?
I've put together 48 laws of trading psychology. So 8 years ago, I think I may have shared a little bit more of my story in the last interview, so I won't go into it in detail. But when I started my journey 8 years ago, I was obsessed with collecting and collating laws of trading psychology, or just laws on psychology in general. I've scoured hundreds of books. I've studied under some great mentors. I've done an enormous amount of work in trading psychology because I wanted to know what the psychology of a successful trader was, so I could become a better trader at the time. And I put together 48 laws. I would love to share the first 12, or we can go into some of it. I don't know if we'll have time to go through all of them. but there are definitely principles or laws that traders can take on board to increase their performance, their profitability, to reduce their stress, et cetera, et cetera. These are proven laws of the human psychology that can help traders. I might just jump to probably the most impactful ones, so we can cover those. We don't waste time going through all of them. But one of the key principles, and by the way, I did a case study on Paul Tudor Jones recently, and this is something I noticed he did as well. There's an interview of him back in the day. I think the documentary is called Trader, when Paul Tudor Jones was a little bit younger and he was trading in the markets. And he had this line in there where he said, traders would do so much better if they stopped wishing and they focused on trading. Never wishing, always trading. Never wishing, always trading. That's the language he used. And that really aligned with what I'd been teaching for a few years, and what I'd been implementing in my own trading for a lot of years. Maybe because I learned it when I read one of his books ages ago and it was sort of logged in my mind, and then I sort of implement that into my teachings. I don't know. But when I rewatched that documentary, I was like, ooh, that really resonates. So it's law 5 of the 48 laws of trading psychology. You have to learn to become expectation free. So many traders are caught up in their own head, what I call the virtual market, creating ideas of what they think is going to happen next in the market. You see, you got the virtual market in your head, you got the real market, which is the market on the screen. And what traders are doing is they're creating ideas of what's going to happen next. Euro dollar is going to move to this price in this amount of time. They've created this idea in their mind, and then they're forcing that onto the real market. They're then expecting the real market to do that. And as every one of you know watching this, nobody can predict what's going to happen next in the market on the next individual trade. There are just so many factors in the financial markets that move price that nobody can actually predict what's going to happen next on the individual trade. So to create an idea in your mind about what you think the outcome of an individual trade is going to be is completely unrealistic. And it's setting yourself up, you're putting your energy on something you can't control. You're setting yourself up to be emotional. What you do is you anchor in your mind, all right, euro dollar is going to get to this price in this certain amount of time. That's going to get me this funded account. It's going to make me this amount of money. That's going to, get me all this recognition in my community and get me this new car. And then if euro dollar doesn't align with that, you're extremely disappointed because you not only lose the trade, but you also lose all those expectations. So traders aren't able to stick to their trading plan. Traders are becoming highly, highly emotional because they're caught up in the virtual market in their head. They're not present with the real market. So what you can do is, before you take a trade, you want to become acutely aware of, what am I expecting from the market? What do I think the market's going to do next? What ideas am I creating in the virtual market? And capture all those, have self-awareness over all of those, and then question it. Hey, Pat, nobody has any idea what's going to happen next. Who am I to try and predict what's going to happen next in this individual trade? And you want to ground those expectations through self-awareness and through questioning, and then ask yourself the most important question before you take any trade is the market aligning with my trading plan right now? Because so many traders are caught up in the virtual market. They're pulled by these expectations and by these fantasies and by these desires for pleasure that they can't actually stick to their trading plan. By going through that process of becoming aware of your expectation, grounding it through questioning, and then adhering yourself to the trading plan, you significantly increase the probability of sticking to your trading plan, building consistent profitability, making money consistently, scaling up with prop firms, reducing your stress. It is probably the most impactful thing any trader can do with their psychology. And that is what Paul Tudor Jones was talking about when he said, never wishing, always trading. Never wishing, always trading. Too many traders are wishing and they're not actually present with the real market trading. And there are a host of sort of psychological things that we can go into the subconscious mind, we can talk about that actually drive that. But that would be probably the most impactful lesson that I've learned over the last 8 years, and I'd love to share.
Yeah, it's definitely interesting. People try to predict the trades. For sure, they try to predict how quick it's going to take them to get to their goal. And those expectations just don't really help that much.
Exactly. And one additional thing on that, you develop an edge based on, you go through backtested data, you backtest Eurodollar, for example, to develop an edge. When you're backtesting, you don't just backtest one trade, you backtest hundreds and hundreds of trades. And at the end of that sample space, you then look at the profitability of your strategy. So your edge, by definition, is determined based on a larger sample space. To then come to the market and expect yourself to be profitable in that one individual trade is completely unrealistic. You have to bring that same mindset you do to backtesting a larger sample space to trading the market in the future. and recognize that it's not about the outcome of an individual trade. It's about the outcome of a larger sample space. And if you are focused every day on the process, not the outcome, but the process of sticking to your trading plan over a large sample space, you will approximate your edge. And that's where consistent profitability comes from. It comes from consistently executing on the trading plan that you've developed based on an edge and sticking to that. It's about the larger sample space, not the individual trade. So we've talked about Law 4, we talked about indirectly at the start about making sure you have a mechanical trading plan. Law 5 is becoming expectation free. Law 1, 2, and 3 is what I call the AIM framework: awareness, intention, momentum. A lot of traders want to set goals, they want to accomplish goals, but they never follow through with those. They want to become a funded trader, a full-time trader, they never follow through with those. A lot of traders want to have motivation, discipline, and focus, yet they're distracted. So I created the AIM framework to help traders accomplish goals, have motivation, have focus. Awareness means you have to be aware of what your life demonstrates is most important to you right now. You have to have awareness of your priorities, your value systems, what you value in your life right now. Your life demonstrates what you value. Your actions show what you value. And if you have an awareness of what you value, that's the cornerstone of human behavior that you can then build your goals on top of. There are so many traders that look at people on social media and they admire them because they maybe made a lot of money in a short period of time. And they say, I want to be that individual. I want to be that person. But then their life doesn't demonstrate that those actions are valuable to them, so they can never sustain that success. So you have to first and foremost be aware of what is of value to you in your life. That's the A, awareness. Then you want to set an intention for where you would love to get to. Set a goal. For example, I want to become a full-time funded trader. That's my goal in the next year, okay? So you have an awareness of who you are right now, what your life demonstrates is most important to you. You also have an I, an intention, a goal. I want to become a full-time funded trader in a year's time. Then the M in the AIM framework, AIM, is you want to build momentum to get you from where you are now to your intention, your goal, the full-time funded trader. The way you build momentum is through the execution of high priority actions every single day. So what I would be doing is I'd be taking a step back and being like, all right, what are the proven strategies to help me become a full-time funded trader? What have other people done to accomplish that goal? Well, first and foremost, you want to develop an edge. You want to learn far and wide through multiple educators to study the markets and to develop a strategy. That's step number one. You want to develop an edge, a profitable edge in the market. Step number two is then putting that edge into a mechanical trading plan. How can you expect consistent profitability if you don't consistently execute on an edge? How can you consistently execute on an edge if every time you come to the market, you feel different and you're trading differently? You have to put that edge into a mechanical system that's black and white that allows you to come to the market and consistently execute. Step number three is then going off and managing fear and greed, learning about the psychology, maybe watching some of my YouTube videos to manage your psychology so that you actually stick to your trading plan. And then step number four is structuring your life to consistently execute on your trading plan with a balanced state of mind. So those are the four proven steps that will get you a funded full-time trader, get you consistent profitability. So then your day-to-day focus needs to be on executing on those four things, on those action steps, right? And then if you want, that's a goal-setting formula there, an awareness of where you are right now, where you would love to get to, and then the proven action steps that will get you there. And then a lot of traders then struggle with motivation and focus to actually follow through with those action steps. So you have to make sure that you link whatever is of value to you right now in your life to that overall goal and to those action steps. So you can see that you going off becoming a full-time funded trader is actually serving and benefiting what your life demonstrates is of value to you right now. So this little AIM framework, a goal-setting framework that traders can implement to ensure that they're following through with their goals, they're building motivation, discipline, all those types of things, and building momentum towards living the life that they'd love to live. So those are laws 1, 2, and 3. Law 4 is mechanical trading plan. You have to develop a mechanical trading plan. Law 5 is become expectation free. We've talked about law 11. That's becoming aware of the other side of a goal. You got funding up on a pedestal. You want to have a look at the drawbacks of it to take it off the pedestal, and you want to plan and prepare for everything that could go wrong. Another great one, we sort of indirectly talked about this today, Etienne, as well, is a lot of traders are killing their confidence. They're thinking they're not very good traders because they're admiring social media traders, or they're admiring their mentors. They're in groups and communities and they're looking at their mentor and they're comparing themselves to their mentor, thinking they're not as good as their mentor, and they're self-minimizing, they're killing their confidence. So law 10 is you have to learn how to see through the dust and the smoke, and you have to recognize that your mentor is a human being just like you. They've got flaws, they've got disadvantages, they've got drawbacks, they have bad trading days sometimes, and you have to learn to take this individual off the pedestal. Recognize first and foremost that, of course, the people on social media and your mentors are going to be putting their best foot forward, right? They're going to be promoting their best side, but they're going to be hiding the side that you don't necessarily want to see. Everybody does that on social media. Everybody puts their best foot forward, right? So recognize that everybody has two sides, everybody's a human being, and that if they can do it, so can you. I love Da Vinci, what he says. He says it's a poor student who doesn't outperform their master. The mentor is laying out a framework for you. Take that framework, utilize it, study other mentors, put your own little framework together, and then outperform these individuals. You should be able to if they're laying out the framework for you. So that's also another important one. Don't idolize social media traders. Don't idolize your mentors. Study from them, learn from them, and then use them as a platform to help you accomplish your goals and help you accomplish your dreams.
That's a good point. Some people see their coach or their mentor as like the thing to follow, and then they want to follow all the trades that person takes. They want to follow all the analysis they have, and that may be good for a while, like in the very beginning, but long term that's just not sustainable. Plus, you need to be able to customize it to your own preference, your own kind of profile or personality.
Yep, I completely agree, and you're so right. It may be something you do initially in the journey, like I want to just mimic my mentor, the trades he takes or she takes, first 6 to 12 months. And then, but then absolutely, if you want to sustain it long term, you have to find and build a system that works for your risk appetite, for your lifestyle, for all the other factors that are part of your life. The only thing that's sustainable is being congruent with your strategy. So, yeah.
What are some of the mistakes people you see make the most in trading? Is it always like a psychology issue? Is it always like the discipline thing, or is it something else that kind of they tend to do wrong?
Yeah, I think it depends on the individual, but I see a lot of traders who are expecting themselves to have good psychologies when they're trading a non-profitable strategy that isn't even put into a mechanical trading plan. It's like you need to patch the holes in the bucket first before you pour more water into it. I think a lot of traders are just they've got a strategy that isn't even profitable in the first place, and they're then expecting themselves to be profitable with a strategy that isn't even profitable. Of course you're going to beat yourself up. Of course you're going to be fearful and greedy and all those types of things. So you have to have a mechanical trading plan that is actually profitable first if you then want to expect your psychology to be on point. I don't know if you can hear that, some bells ringing. So first and foremost, develop an edge that's profitable, put it into a mechanical trading plan, and then learn to manage fear and greed. That's probably one of the most common things I see with traders. Then there's a lot of traders who are thinking in this state of pride and this state of invincibility that they can predict what's going to happen next in the market. What I've observed with the best traders I've worked with, and that I've observed and had the opportunity to get coaching from, et cetera, is that they're very humble to the market. They're very curious. They have this sense of curiosity of, I don't know what's going to happen next, but I'm very curious to see what's going to happen next. And obviously they also think that they don't need to know what's going to happen next because their job as a trader is just adhering to their edge. So the other mistake here is a lot of newer traders thinking they can predict what's going to happen next on the next individual trade, which has a whole host of problems. But the truth is you don't need to, right? That's another big challenge. I see a lot of traders right now emulating and trying to, they're idolizing social media traders and their mentors and stuff like that. Another big trap. I see a lot of, another one I'm going to elaborate on because this is going to maybe upset some people, but there are a lot of people in communities thinking that, and I want to do a YouTube video on that, a proper one, that there's this almost like this cult mentality. Like they have this strategy, and then if anybody's going counter to that strategy, that person's evil. They're a bad person. I need to attack them, right? And they've got this strong bias on their own strategy. Now I'm just going to go on the record and say I'm a big believer in communities. A lot of actually some of my close friends that some of my best friends I met in trading communities. So I'm a big promoter of trading communities for the social aspect, for the tribe and the bonding and the ability to learn very quickly from other individuals. But you have to be aware that a big trap to fall into with confirmation bias is thinking that the strategy you're trading is the only way to trade the markets and it's the only profitable way to trade the markets. You put yourself at a disadvantage and you put yourself in a vulnerable position if you're trapped in that mentality. And it doesn't mean that you don't just trade. It doesn't mean that you trade multiple different strategies or you jump around from strategy to strategy, but at least have at the back of your mind that there are vulnerabilities and there are disadvantages and there are drawbacks to the way you trade. Every strategy has its pros and it has its cons. It's got its benefits, it's got its drawbacks. It's got conditions, market conditions that it performs very, very well in. It's got market conditions that it won't perform well in. And you have to be aware of both sides of your strategy. Don't fall into this trap. I was guilty of it as well in the past, of thinking that your strategy is the only way to trade the market. It's the only profitable way to trade the market, because I guarantee you it's not. It's seasonal. It's dependent on the market condition. And it's sometimes wise to open your mind to realize that I may actually need a secondary strategy or a rendition of my strategy or a different way I execute my strategy in different market conditions. Very important to keep that thought at the back of your mind. Yeah.
Yeah, also a very big one. And you see this a lot with the YouTube kind of gurus about trading, when they kind of share that their way of trading is the only way of trading, and like that's the only thing you can do and that's the only thing that works. It's just not the case. When you talk with traders, you see there's like so many different ways to trade and so many different things you can do. And you'll be like surprised that like people do it like a different way than you do. And it's kind of cool to learn.
Yeah, open your mind. Of course, everybody's going to think that their way is the best way. That's just how it is, right? I obviously think that my trading psychology is the best trading psychology stuff out there, because it is. No, it's not. Maybe, I don't know. But it's you put yourself at a disadvantage if you don't open your mind to other schools of thought. And this is a commonality that I've seen with the most successful traders, is that they're so open, they're so teachable, they're so humble to recognize that what they're doing now may not work in 2 to 3 years' time. And what they're doing now may not be the best thing out there. So yeah, it's just a different mentality. It's the traders who stick around are the ones who are more resilient and they're more adaptable. They're like water, they become formless. And if they need to change their strategy or they need to put up a secondary strategy because now the market condition is choppy, they do it. And they're not attached to, they're attached to achieving their goals. The way they achieve their goals can change. They're not attached to the strategy they trade or the way they do that. They become adaptable. So yeah, that's something I've definitely observed with very, very successful traders.
You mentioned a couple of times having a mechanical system. Now, I know some people who will say, oh, the only way to make money trading is with discretion. You got to like pick the right trades. You got to look at the charts. You got to like be discretionary. How do you respond to that? And what do you think mechanical makes it better or I don't know, simpler?
I don't know. Look, I can give you two perspectives on this. The first argument against sort of what you said is that my question here is, how can you expect consistent profitability, right, if you're not consistently executing on an edge? It just doesn't make any sense in my mind. How can you expect consistent profitability if every time you come to the market you feel different, you trade differently? How can you then reap the rewards of an edge over a large sample space? How can you approximate that probability model? So I'm a big promoter initially when you start off in your journey that you want to identify an edge and you want to put that edge into a mechanical trading plan and you want to solidify that and you want to make it black and white and you want to stick to trading your edge. However, and this is where you differentiate a more amateur trader to more of an expert trader. Because I've also worked with traders. I was working in an in-house prop firm in Sydney, Australia, with a trader there who would use intuition, right? They knew what their base strategy was, but there were days when they had intuitive, creative thoughts about what could potentially happen. They had this intuitive hunch, and they followed that intuitive hunch, even if it meant breaking their rules, and they were profitable because of that intuitive hunch. But that trader also had 20 years of experience trading an enormous amount of capital, and they were very, very good at what they did. So my argument here is a lot of amateur traders think they're using intuitive thought, but really what they're doing is they're running off on that fantasy in the virtual market in their head. So sort of the conclusion I came through all my research and through all that type of stuff is that you want to start with a mechanical trading plan. You want to learn how to master your emotions and learn how to differentiate fear, greed, and intuitive thought. Because when you have a mechanical trading plan, when you then learn how to manage fear and greed, you heighten your intuitive thought because you're most present with the market. And then only after you have experience in the market, 5, 6, 7, 10 years in the market, do I think you then start to use intuitive thought. I use the analogy on another podcast. It's like, I'm a terrible golfer. I was playing golf in the weekend. I'm not very good. It's like, and then you have Tiger Woods. If you were to put me and Tiger Woods side by side, Tiger Woods, because he's mastered the foundations of golf, he's one of the greatest golfers of all time. Because he's mastered the foundations, he can then use intuitive thought on the way he hits the ball and how much he hits it with, etc. I don't even know, right? But me, who is a complete novice in golf, if I was saying I'm using intuitive thought, I'd be kidding myself because I haven't even mastered the foundational principles of golf in the first place. I think it's no different for trading. You have to master the foundational principles. You have to master a mechanical system, your emotions, and then will you have intuitive thought? Because you can't have intuitive thought if your emotions are running rampant. Too many traders confuse intuitive thought with greed and that the fantasy and the unrealistic expectations. That's a big trap that I see traders falling into. So, yeah, I don't promote intuitive trading unless it's a very advanced trader that has certainty in the intuition.
I think it's very tricky, and you gotta track whether your intuition helps your results too. Like, I know guys who've been trading for 20 years and more, and they still feel like whenever they go on intuition, they kind of lose money and they perform bad. So they prefer to just stick to the system. So you have to track it, see if it makes a difference or not. But I think for a lot of people, it does make a difference. Or you're actually better just kind of following something mechanical.
Yeah, I would agree, and that's what I say, because that's for majority of people is gonna be most profitable. But I would also question. I mean, I don't know the guys you're talking about, but if I was to have a conversation with them, I would go back to that and I would see, was that truly intuitive thought, or was that just a greed complex where you got caught up in the virtual market in your head and you, in a state of pride, forced an idea onto the market and got humbled because of that. Too many traders confuse intuition with greed, and that's a very tricky one to overcome. It takes a lot of time, a lot of experience, a lot of mindset work. Yeah,
that's a good point. Yeah, pretty cool. So where can people find you? They want to connect with you or reach out after this interview?
Well, I have a YouTube channel. I've got it's my name, Pat Bailouni. If you type that into YouTube, you may even need to type in trading mindset, Pat Bailouni trading mindset. I've got hundreds of videos on trading psychology. I only talk about trading psychology. What I encourage traders to do is to go through that, watch my videos, and go through them, see if you resonate with what I've talked about, etc., etc. There's a lot of value on that YouTube channel. I've also got my Instagram, which is Master Your Trading Mindset, which I'm starting to do more and more on the Instagram as well. So if you resonate with what I talked about today, check out my YouTube first, check out my Instagram second. If you have any questions, message me on IG or email me or comment on my YouTube. I don't know, I'll get back to your messages there.
Awesome. Yeah, you definitely have some good content on YouTube, so people can check it out. I'll leave a link below the video here on YouTube. And the podcast channel, people can check it out there directly for sure. And Pat, I appreciate your time here and the advice you give to the listeners. There's been a lot in this, and I really appreciate it. And let's catch up soon and discuss more. It'll be cool.
Amazing, Etienne. Thank you so much for having me on again. It's always a pleasure speaking with you.